Tony Travers, you've written and opined on many of these capital finance issues in the past. I mean, do you share our general analysis that the sort of spat between the two front benches in Parliament as they both try and outprove one another that they are tougher on public sector debt is going to harm essentially our capital investment futures? Is that a fair assumption?
Yeah, do you want me to stand up
yes,
and
please,
speak?
Yes.
Right. A helpful prompt, because one of the things I was going to begin by saying, apart from congratulate the new local government network and its sponsors on the excellent publication, is that of all of the issues, I mean, there's been a lot of criticism of Labour and Conservative front benchers for not being open and honest with the extent of the cuts or tax increases that we may need in the years ahead. But one thing that the government has been willing to do is to say categorically that public sector capital expenditure will be cut by 50% between 2011-12 and 2013-14, slightly more. And interestingly, the Conservative opposition hasn't taken them to task for a penny of that, the implication being that they agree. If they daren't say anything else, or they'd be criticised and say, well, what would you cut instead? So it's a curious piece of agreement about the need for a really big cut. And it's it's exactly what happened during the 1970s, when there were major public spending cuts, and in the early 80s when there were major public spending cuts. And that is the relatively easy option of public sector capital cuts triumph over the hideous idea of, in effect, having fewer doctors, teachers, nurses, less provision for the under fives, and all the things that are much more visible. This is a serious political difficulty, but it doesn't mean that trying to find countervailing ways of reinforcing the possibility of capital investment by the public sector or jointly between the public sector and its private sector partners doesn't mean that that isn't something we should strive for. Indeed, it reinforces the need for having to do it. So I think local authorities do now face the position of trying off their own bat to provide some countervailing investment. And as we've already heard, not only, in fact, local government debt has been falling for years. Local authorities are no longer particularly indebted. More to the point, they have massive reserves and investments. Not something that they've been particularly happy to talk about, because they were for years generating large revenue streams because of high interest rates. Now high interest rates are no longer high. The scale of reserves is less beneficial, and as far as I can see from the headline figures that the Treasury publishes, authorities are beginning to use some of the investments to pay off some debt in order to bring down debt charges, which is now a better thing to do. The NLGN publication does outline alternative ways forward. We've just heard about some of these, revenue bonds, the use of investments, the complexities or the potential of using superannuation pension funds, though there are legal constraints on that, but the report does talk about the idea of pooled investments, the way it might be ways around the constraints on using what are very large sums of money that authorities, employees or ex-employees have in these superannuation funds, but which actually are finding it very, very difficult to invest themselves in a way that produces a good long-term return. The question, would investing in projects within Britain be a good place to would it be a good place to invest? Well, actually, not bad, actually. Very good place, very reliable place to invest money. There is a wider need for flexibility, and the report argues this. Everybody knows, and Phyllis Starkey's Select Committee very strongly made this point earlier this year, capping is a barrier not only to revenue but also to capital expenditure. The report makes that point. There have been minor chipping away, minor signs that the Treasury occasionally can be defeated. Business improvement districts, LABGI, anybody who doesn't know what that is doesn't want to know what it is, business rate supplement, amazing concession from the Treasury, business rate supplement. I mean, it breaks about 50 of their rules all at once, but they have just about conceded it. The report looks to the possibility of accelerated development zones, tax increment finance, as Americans call it. And again, to get that into place is going to require the Treasury to be brought round to the idea, let's put it as kindly as I can. The Treasury will have to take another deep breath if it's going to allow that. So there are possibilities. I noticed that as we move up to the general election, there's a bit of competition between the political parties about things that might happen after an election. The Conservatives have come up with this idea of allowing councils that give planning permission for housing to keep the council tax yield for a while. In fact, I think they've now agreed to back it up with extra support. I would expect to see the Labour Party investigating this field as well in the run-up to the election. And there's no question that local authorities will need revenue streams to finance any of the forms, or pretty well any of the forms of finance other than taking money out of the bank, that are likely to be discussed at an event of this kind. So I just finish with the idea that the real issue we all face, and will always face, whatever party is in power, is the iron grip of the Treasury. Now, there's an argument for the iron grip of the Treasury. If it were not for the Treasury, everything would doubtless go to the dogs. However, it has led to excessive centralisation, another point that the Select Committee report stressed earlier this year. And all I'd say to our friends in the Treasury, or to anybody who meets them, is that A, local government has extraordinarily strong finances. No council has ever defaulted on a payment of any kind, ever in history. Not even Liverpool, not even Clay Cross, not even Poplar. None of them have ever defaulted on a payment. And indeed, the repayment on outstanding debt is a first call on revenues anyway. So local authorities are as good a place, as trustworthy a place to lend money, or indeed to be involved in these kind of projects as you can imagine. Councillors still have reasonable degrees of trust, not doing too badly there. They are solvent. The extent of their reserves and investments, as we've all agreed, is surprisingly high. And there was a point, I think, it's been recorded, so maybe saying don't quote it. I'm pretty sure there was a point when local authorities' total reserves and investments were actually, if anything, bigger than the central government, than the UK government's investments. I think it's true to say that. Certainly that's what the Blue Books, the Treasury's Blue Book suggests. And of course the other thing about local authorities is they are curiously long-term survivors. They've been around for a very long time. There are a lot of people, many represented in the room, who thought innovatively about how, with just a bit of flexibility, it would be possible for them to release a bit of entrepreneurial skill, along with their private sector colleagues, regional agencies and various kinds of other bodies, simply, and now the prize is, not just to keep regeneration going, but actually to act as a sort of slight countervailing force to what I think everybody worries is if public spending is withdrawn too quickly in the months and years ahead, there is just the slightest risk that economic activity could bump along at a lower level than the 2.5% trend growth that Britain had been used to. So I think the prize is better than, it's more than just flexibility. It's actually something to do with improving local and regional infrastructure and indeed supporting the return of economic growth. Thank you.